Consumer sentiment taking a hit as inflation fears remain. Now, this month's prelim reading showing that sentiment actually fell to the lowest level that we've seen in 6 months. Here to break it all down, what exactly this is telling us maybe about growing weakness within the broader economy, if at all. We want to bring in Jeffrey Roach. He is LPL Financial's chief economist. Jeffrey, it's great to have you here. So talk to me just about that sentiment reading. I think spooked some investors, maybe to some extent here, just the fact that it did fall to the lowest level that we have seen in 6 months. But is there any takeaways that you're seeing just in terms of what that could ultimately signal about the health and the strength of the economy?
Well, good morning. Thanks for having me. And yes, I think it was interesting for investors because we got a little bit of confirmation from the conference board's release, told us something about consumers pivoting away from big ticket items. We got that confirmation in the latest survey from the University of Michigan. And I think what this tells us really is that the slowdown is starting to happen. But I don't know if we will understand quite the magnitude quite just yet as consumers do pivot away from those big ticket items. I think another thing that was a key driver for last week for markets was the latest estimate and blog post from the San Francisco Fed talking about excess savings being drawn down. So I think it's fair to expect the second half of this year is going to be running a lot slower than what we saw throughout 2023.
And Jeffrey, when it comes to the inflation prints that we will be getting later this week, specifically the CPI report, we are expecting to see maybe some easing when it comes to the pricing pressures that we have seen. But how long is it going to be until we see that material improvement that the Fed is looking for in order to be confident, maybe ultimately to cut rates?
Well, I think the Fed's looking for confirmation that the economy is slowing, so aggregate demand slows, which means consumers just aren't splurging as much. Hence, we'll see that pullback in pricing. It's been a tough time, and I think it's been a little bit of a disappointment because as we've all had to come to this realization that the 2% target that the Fed is looking for is going to take a lot more time to reach that target. We're not going to get to it as quickly as we originally thought. Yeah, I think we'll end this year around a 2.8%. Again, it's above the 2% target, but we're going in the right direction. And I think that's where markets might respond quite favorably. In terms of Wednesday, so you're exactly right. This week, all eyes will be on another print from the CPI. It's not the Fed's preferred metric. The PCE deflator comes from the personal income and spending report. That's their favorite metric, but either way, this will be closely watched. I think one of the things you look for here is look past the headline. It's going to be supported by the rise in gas prices. Look at vehicle insurance and look at rent. I think we're going to start seeing finally the industry data flow through the official government stats and see rent prices start to ease a bit.
Jeffrey, will we see enough improvement in order to keep those rate cut hopes alive before the end of the year?
Well, probably not. So we had 3 consecutive disappointing reads. Mm-hmm. January was quite hot, February, March. So even if this comes in a little bit better than expected, I think policymakers will say, okay, look, we got to make up for all the disappointments the first 3 months of the year. But I do think one thing that we can say with a little more certainty is we can take the rate hikes off the table. Remember, just a couple of weeks ago, there was a little bit of kind of clamoring and chattering about rate hikes. I think that's not going to happen, but we need to have a little more confirmation that we can get those 2 cuts. My view is we will get at least 2 cuts, perhaps not starting until September, but we'll start seeing the easing of inflation in this report, but we have to see some more confirmation in subsequent reports.
Jeffrey, I'm curious, before we let you go, I was talking to Mark Zandi over at Moody's about this last week, and he was making the case that 2% doesn't make sense maybe anymore, that should be the Fed's target. Maybe it should be something even higher, even floated the potential here of 3%. I'm curious, where do you stand in that debate, and maybe how much, whether or not there should be more of an emphasis just on the fact that maybe 2% isn't the new normal?
Well, it's fair to say, and I'll echo what some of my other colleagues say. There's nothing magical about 2%, mm-hmm. but what is special is that global central bankers have agreed to that number. So if we have to start talking about inflation running a little bit hotter, particularly as demographics change, the structure of the labor force changes, perhaps it's not 2% anymore. But that conversation has to be a global one. It can't be just in the confines of this country.
All right, Jeffrey Roach, we'll leave it there. Thanks so much for hopping on and joining me here this morning. LPL Financial's chief economist. Appreciate it.
Thank you.